Arthur Andersen, How Enron Killed the World's Top Auditor. Once the most prestigious accounting firm globally, Arthur Andersen collapsed overnight when their role in the Enron scandal destroyed 89 years of reputation. 85,000 employees lost their jobs because of one client's lies. This is the story of how the world's most trusted name in accounting became synonymous with corporate corruption, and how a single client relationship brought down a century-old empire built on integrity and excellence. Arthur Edward Andersen founded his accounting firm in Chicago in 1913 with a revolutionary philosophy that would define the company for decades. When a client pressured the 28-year-old Andersen to approve questionable financial statements, he refused, famously declaring there was not enough money in the city of Chicago to make him compromise his principles. This moment established the foundation of what would become the Big Five accounting firm's core value: integrity above all else. Andersen built his practice on the radical notion that auditors should be independent watchdogs, not compliant servants to corporate management. By 1925, the firm had grown significantly, landing major clients like Colgate-Palmolive and establishing a reputation for rigorous accounting standards that other firms struggled to match. The company's motto became, "Think straight, talk straight," embodying Andersen's belief that accountants had a duty to tell the truth regardless of the consequences. During the Great Depression, while other accounting firms collapsed or compromised their standards to survive, Arthur Andersen thrived by maintaining its unwavering commitment to accuracy and independence. The firm's insistence on proper accounting practices during this tumultuous period actually attracted more clients who valued reliability over convenience. By 1940, Arthur Andersen had become one of America's most respected accounting firms, with offices across the Midwest and a growing national presence. The post-war economic boom transformed Arthur Andersen from a respected regional firm into a global powerhouse. In 1952, the firm made a prescient decision that would define its future. They established one of the first dedicated computer consulting divisions in the accounting industry. This move into technology consulting proved incredibly lucrative as American businesses began adopting computer systems for financial management and record-keeping. Arthur Andersen's consultants didn't just audit books. They helped design the very systems that generated those financial records. By 1957, the consulting division was generating substantial revenue and attracting top talent from engineering and business schools. The firm's client list read like a who's who of American industry, including General Electric, Caterpillar, and dozens of Fortune 500 companies. Arthur Andersen's reputation for innovation and integrity made them the auditor of choice for companies going public during the 60s economic expansion. The firm's partners commanded premium fees and wielded enormous influence in corporate boardrooms across America. By 1970, Arthur Andersen employed over 20,000 people worldwide and had established offices in major cities across North America, Europe, and Asia. Their distinctive culture of excellence and attention to detail had created what many considered the Harvard Business School of accounting firms. The 1980s brought unprecedented growth, but also the seeds of future destruction. Arthur Andersen's consulting business exploded as corporations invested heavily in computer systems and business process reengineering. The consulting fees often dwarfed traditional audit revenues, creating a fundamental conflict of interest that would later prove catastrophic. Partners who brought in lucrative consulting contracts were rewarded with higher compensation and greater prestige within the firm, while traditional auditors found themselves increasingly marginalized. By 1989, Arthur Andersen Consulting generated more revenue than the audit division, fundamentally altering the firm's priorities and culture. The pressure to sell consulting services to audit clients intensified as partners realized they could multiply their fees by offering both services to the same company. This dual relationship created an inherent conflict. Auditors were supposed to independently verify the financial statements of companies whose business processes they had helped design and implement. The firm's leadership dismissed concerns about independence, arguing that their reputation for integrity was unassailable and that the additional revenue would fund better audit procedures. During the savings and loan crisis of the late 80s, Arthur Andersen's audits of several failed institutions drew regulatory scrutiny, but the firm's political connections and legal resources helped minimize the fallout. By 1990, the tension between auditing and consulting had created two distinct cultures within Arthur Andersen, with consultants viewing themselves as elite advisors and auditors feeling relegated to commodity service providers. The 1990s witnessed Arthur Andersen's transformation from a principled accounting firm into an aggressive business advisory empire. The firm's consulting division grew so large and profitable that in 2000, it split off to become Accenture, taking billions in revenue and thousands of employees. This separation was acrimonious and expensive, forcing the remaining Arthur Andersen to become even more dependent on audit fees and the consulting services they still provided to audit clients. The firm's culture shifted dramatically during this period, with partners increasingly focused on maximizing revenue per client rather than maintaining auditing independence. Young auditors were trained not just in accounting principles, but in identifying opportunities to sell additional services to their clients. The firm's compensation system rewarded partners who grew client relationships, often without regard to the potential conflicts of interest these expanded relationships created. Arthur Andersen began aggressively pursuing high-growth companies, particularly in the energy and technology sectors, where complex transactions and innovative financing structures required sophisticated accounting treatments. The firm's Houston office became particularly successful at landing energy clients, including a rapidly growing natural gas company called Enron Corporation. By 1995, Arthur Andersen had audited Enron for several years while also providing extensive consulting services, helping design many of the complex financial structures that would later become notorious. The Enron relationship was incredibly lucrative, generating over $50 million annually in combined audit and consulting fees, making it one of Arthur Andersen's most important clients. The relationship between Arthur Andersen and Enron represented everything wrong with the modern accounting industry's conflicts of interest and compromised independence. David Duncan, the Arthur Andersen partner responsible for the Enron audit, was deeply embedded in the client's business operations, spending more time in Enron's offices than his own firm's Houston headquarters. Arthur Andersen consultants had helped design many of the special-purpose entities and complex financial structures that Enron used to hide debt and inflate profits. The firm was essentially auditing its own consulting work, a clear violation of the independence principles that Arthur Edward Andersen had established decades earlier. When Enron's finance team proposed increasingly aggressive accounting treatments, Arthur Andersen's auditors rarely objected, fearing they would lose the lucrative account to a competitor willing to be more accommodating. The firm's internal risk management procedures, once considered the industry's gold standard, were systematically ignored or overruled when they conflicted with client relationships. Arthur Andersen's Houston office had effectively become a subsidiary of Enron, with auditors rotating between the two companies and former Andersen partners joining Enron's senior management team. This revolving door relationship made truly independent auditing impossible, as current Andersen employees knew their future career prospects might depend on maintaining good relationships with Enron executives. By 2000, several Arthur Andersen partners in other offices had raised concerns about the firm's relationship with Enron, but these warnings were dismissed by partners who viewed the account as untouchable due to its enormous profitability. The firm's quality control mechanisms, designed to catch problematic client relationships, failed completely in the case of Enron, allowing increasingly questionable accounting practices to continue unchecked. The Enron scandal erupted in late 2001, exposing a massive fraud that had been facilitated by Arthur Andersen's compromised audits and aggressive document destruction. When Enron's financial manipulation began unraveling in October 2001, Arthur Andersen employees in the Houston office began systematically destroying thousands of documents related to the Enron audit. Over the course of several weeks, Andersen personnel shredded not only paper documents but also deleted electronic files and destroyed computer hard drives containing evidence of the firm's role in Enron's accounting fraud. This document destruction continued even after the Securities and Exchange Commission had begun investigating Enron and had requested that all relevant documents be preserved. The shredding only stopped when Arthur Andersen received a federal subpoena demanding the preservation of all Enron-related materials, but by then, it was too late to save the firm's reputation. The destruction of evidence suggested consciousness of guilt and transformed Arthur Andersen from a victim of client deception into an active participant in covering up corporate fraud. Congressional hearings revealed the extent to which Arthur Andersen had compromised its independence, with lawmakers expressing shock at how thoroughly the firm had abandoned its founding principles. The revelation that Andersen had earned $27 million in audit fees and $25 million in consulting fees from Enron in 2000 alone demonstrated the financial incentives that had corrupted the auditing process. Media coverage portrayed Arthur Andersen not as the prestigious firm it had once been, but as a co-conspirator in one of the largest corporate frauds in American history. The firm's attempts to distance itself from the scandal failed as more details emerged about how deeply Andersen personnel had been involved in designing the very financial structures they were supposed to independently verify. The collapse of Arthur Andersen happened with stunning speed, as clients fled and regulators moved to shut down the firm's operations worldwide. Within weeks of the Enron scandal breaking, major Arthur Andersen clients began terminating their relationships with the firm, fearing association with the tainted auditor would damage their own reputations. The Securities and Exchange Commission launched a formal investigation into Arthur Andersen's auditing practices, while the Department of Justice began building a criminal case against the firm for obstruction of justice. By early 2002, Arthur Andersen was hemorrhaging clients and revenue as companies rushed to hire replacement auditors from the remaining Big Four accounting firms. The firm's international partnerships began dissolving as Arthur Andersen affiliates in other countries sought to protect their own operations from the American scandal. In March 2002, the Justice Department indicted Arthur Andersen on charges of obstruction of justice for destroying Enron-related documents, making the firm the first major accounting firm ever to face criminal prosecution. The indictment effectively ended Arthur Andersen's ability to conduct audits, as public companies could not hire an auditor under federal criminal indictment. Even before the trial began, Arthur Andersen had lost most of its remaining clients and was forced to begin laying off thousands of employees worldwide. The firm that had once employed 85,000 people across the globe was reduced to a skeleton crew of lawyers and executives managing the liquidation process. In June 2002, a federal jury found Arthur Andersen guilty of obstruction of justice, formally ending the firm's 89-year history and putting the final nail in the coffin of what had once been the world's most prestigious accounting firm. The destruction of Arthur Andersen sent shockwaves through the entire accounting industry and led to fundamental reforms in how public companies are audited. The Sarbanes-Oxley Act, passed in 2002, prohibited accounting firms from providing most consulting services to their audit clients, directly addressing the conflicts of interest that had corrupted Arthur Andersen's relationship with Enron. The legislation also established the Public Company Accounting Oversight Board to regulate auditing firms and mandated that audit partners rotate off client accounts every 5 years to prevent the cozy relationships that had compromised auditing independence. The collapse reduced the Big Five accounting firms to the Big Four, concentrating even more power in the hands of the remaining firms and making the auditing market less competitive. Thousands of Arthur Andersen employees found themselves unemployed through no fault of their own, as partners in offices around the world who had maintained the highest ethical standards were punished for the misconduct of their colleagues in Houston and Chicago. The firm's international affiliates were forced to merge with competitors or close entirely, disrupting audit relationships and business operations in dozens of countries. Many former Arthur Andersen clients struggled to find replacement auditors, as the remaining Big Four firms lacked the capacity to immediately absorb thousands of new audit engagements. The Supreme Court eventually overturned Arthur Andersen's criminal conviction in 2005, ruling that the jury instructions had been flawed, but this vindication came too late to save the firm or restore the jobs of its former employees. The legacy of Arthur Andersen serves as a cautionary tale about how quickly a century-old reputation can be destroyed when short-term profits are prioritized over fundamental principles of independence and integrity. Arthur Andersen's spectacular collapse from the world's most trusted auditing firm to a symbol of corporate corruption demonstrates how conflicts of interest and compromised independence can destroy even the most established institutions. The firm that Arthur Edward Andersen built on the principle of thinking and talking straight was ultimately killed by partners who prioritized consulting fees over auditing integrity, choosing short-term profits over the long-term reputation that had taken nearly a century to build. The Enron scandal didn't just expose accounting fraud. It revealed how thoroughly the auditing industry had abandoned its role as independent watchdog in favor of becoming a compliant business partner. The 85,000 Arthur Andersen employees who lost their jobs paid the ultimate price for management decisions that prioritized growth and revenue over the ethical principles that had made the firm great. Today, the Arthur Andersen name exists only as a legal entity managing the firm's remaining liabilities and as a reminder of how quickly integrity, once lost, can bring down even the mightiest corporations. The firm's collapse reshaped the entire accounting industry, leading to reforms that, while necessary, could not undo the damage to public trust in audited financial statements. Arthur Andersen's story serves as a permanent warning that no company, regardless of its history or reputation, is too big or too prestigious to fail when it abandons the principles that made it successful in the first place.